Most people use their checking account and savings account completely wrong, and it's costing them hundreds of dollars a year. Keep watching and I'll explain everything you need to know, what each account actually does, how they're different, and exactly how to use them together so your money is always working for you. Here's the simplest way to think about it. A checking account is for spending money and a savings account is for storing money. That's the core difference between checking and savings. A checking account is essentially the hub for your finances. This is where all of your money flows in and out. There's typically a lot of activity in this account. You can write checks or use your debit card to make payments directly from the account. You can go to an ATM and deposit or withdraw cash from the account, and there are typically no limits to how many transactions you can make in a month. I recommend keeping 1 month of expenses inside of your checking account to act as a buffer. This protects you against overdrafting and allows you to start budgeting a month ahead so you aren't waiting until payday to pay your bills. Now, anything outside of this buffer needs to be put to work. That's where our savings account comes in. A savings account is for specific financial goals like an emergency fund, saving for a down payment, a wedding, a car. It keeps your spending money separate so you aren't tempted to dip in. Think of it this way. Your checking account is like an airport. Money flies in and out all the time, and your savings account is the destination. Now let's get into the differences between a checking and savings account. Starting with debit cards, these are usually issued to you when you open up a checking account to get direct access to your funds for spending. With a savings account, you typically don't receive a debit card, and that is by design. This is because savings accounts are not meant to be spent from often, and that helps reduce the temptation to spend the money that's sitting there. Next, withdrawals. Checking accounts give you multiple options: checks, debit cards, ATMs, automatic bill payments, wire transfers. Checking accounts are designed to give you easy access to your money with unlimited transactions. Savings accounts are more limited. One of the most common ways to access money is just transferring from your savings account to your checking account. This usually takes 1 to 2 days, but you can still withdraw money using an ATM. Here's a quick history lesson. There used to be a federal rule limiting savings account withdrawals to 6 per month. In 2020, this was removed. Today, most banks allow unlimited transactions. There are still some that limit you to 6, so it's important to check the fine print before opening. Now let's discuss my favorite topic: interest. With checking accounts, since this is designed as a hub where your money passes through, interest rates are typically either low or zero. With a savings account, this is where your money sits and grows. With traditional savings accounts, you can expect around 0.01% APY, but with something called a high yield savings account, you can earn a much higher interest rate. It's best to keep any savings in a high yield savings account so you can earn more on the cash you have sitting there. The reason banks can offer higher interest rates with high yield savings accounts is because they're usually online banks. This means they don't have the same overhead costs as a traditional brick and mortar and can pass along the savings to you and me. Watch my other video on Chime's channel where I explain APR versus APY and dive into interest rates even more. Let's talk about typical balances you can expect in each account. As I mentioned earlier, I recommend keeping 1 month of expenses inside your checking account as a buffer. This is the most that I would keep here. With a savings account, this number will be higher. The typical rule of thumb for an emergency fund is 3 to 6 months of expenses. And on top of your emergency fund, you might have savings in sinking funds where you set aside money for future spending like the holidays or vacation. You might be saving for a new car or a down payment on a house. All of this is going to increase the amount in your savings account. Now let's get into monthly fees. Some checking accounts charge monthly maintenance fees, usually $5 to $15, but many banks waive the fee if you set up direct deposit or maintain a minimum balance. Always check for this. Savings accounts sometimes require a minimum balance to earn the advertised APY or to avoid fees. High yield savings accounts tend to have fewer fees and lower minimums, which is another reason I recommend them. Opening a checking or savings account is pretty straightforward. Here's what you'll typically need: a valid government issued ID, driver's license, passport, state ID, your social security number for identity verification and tax reporting, an initial deposit. Some accounts require as little as $0 to open, others need $25 to $100. You can open an account in about 10 minutes. Here's what to look for when choosing your accounts. For a checking account, prioritize no monthly maintenance fees or easy ways to waive them, a large fee-free ATM network, direct deposit availability, a clean, easy-to-use mobile app, and overdraft protection options. For a savings account, especially a high-yield savings account, prioritize the highest APY you can find, compare rates across multiple banks, no minimum balance requirements, no monthly fees, FDIC insurance, this is a non-negotiable, and easy transfers to and from your checking account. Okay, let's get into a real example so you can see checking versus savings in action. Meet Alex. Alex already has $3,000 as a buffer in their checking account to cover bills and spending without stress. This is our baseline. Remember, roughly 1 month of expenses. Alex gets paid $2,000 every 2 weeks, and those paychecks all land in their checking account via direct deposit. So in a month, they make about $4,000. Here you can see Alex's fixed expenses. That's $2,850 every month on expenses. Remember that $3,000 buffer? That's gonna cover about a month of Alex's expenses so they can cover bills and spending without stress. Now, everything outside of this buffer and our expenses needs to go to work. Step 1, sinking funds. Alex has a high yield savings account, and this gives them higher interest on the money that sits in this account. This is where Alex sets aside sinking fund money. This is savings for future spending. Alex's car insurance bill costs $600 every 6 months. Alex also sets aside $100 every month towards Christmas presents. That way there's no stressing during the holidays. This means every single month she sets aside $200 for sinking funds so she isn't caught by surprise. Step number 2, emergency fund. That leaves us $950. Alex currently does not have an emergency fund, so this is our next priority. This will all go into their savings account and we'll start building up that emergency fund. The goal is to have 3 to 6 months of expenses saved here. Because Alex uses a high yield savings account, the money they have here is earning interest every single month, which helps speed up their savings journey. So a checking account is money for this month and your savings account is for future you. This isn't about being perfect, it's about giving your money a job and setting up the right systems in place that work for you, not against you. Before we wrap up here are 3 mistakes I see people make all the time. Number 1, keeping too much money in checking. Anything beyond your 1 month buffer is sitting there earning nothing. Move the access to your high yield savings account. Number 2, not having a high yield savings account. If your savings are in a traditional savings account earning 0.01% APY, you're leaving money on the table. Switching is quick and simple. Number 3, treating savings like a second spending account. Your savings account should feel slightly inconvenient to access. That's a feature, not a bug. If you're consistently transferring money back to checking, revisit your budget. If you only do one thing after watching this video, open a high yield savings account and set up an automatic monthly transfer from checking to savings. Even $50 a month adds up. Here's a recap. A checking helps you manage your month to month, and a savings account is there to help you breathe. If you have an emergency, your emergency fund will be there to help pick up the pieces. And when the holidays roll around, you already have money saved for it. If you found this video helpful, check out more videos on Chime's YouTube channel for money tips and tricks like this. Thanks for watching.